Look, I want to tell you about something that happened to me in 1929. I lost 70% of my capital. Not because I was stupid, not because I couldn't read a balance sheet. I paid too much. That's the whole story. My clients lost money. People who trusted me lost money. And that failure taught me more than any success ever could. So here's what I want you to understand about bull markets, because this will happen to you. You'll make one exception to your standards, just one. You'll find a company you love, price is high, but you'll tell yourself it's a wonderful business, it deserves a premium. And then you'll stop asking the question that matters, which is, at what price does wonderful become stupid? In 1928, I was doing everything right, analyzing balance sheets, studying earnings, looking at competitive positions. But somewhere along the way, I stopped demanding a margin of safety. I started accepting prices that required everything to go perfectly. That's not investing, that's hoping. The Dow climbed from 64 in 1921 to 381 in 1929. Every single year, the skeptics said it couldn't continue. Every year, they were proven wrong. After a while, skepticism itself looked foolish. I remember sitting in my office looking at stocks trading at 25, 30, even 40 times earnings, companies with no dividend history, businesses built on death and optimism. And I bought them. Not because my analysis told me to, but you know what it's like. Your neighbor makes 50% one year, your colleague buys some stock that doubles. You just can't sit there while everyone else is getting rich. That's the real poison of bull markets. They don't just make prices go up, they make discipline feel like cowardice. Now, a student once asked me, "Professor Graham, how do you know when to sell?" And I told him, you don't need to predict when the market will turn. You need to know what you're paying for a business. Here's the question you need to ask yourself. If you could buy this entire business privately, would you pay this price? Can you calculate, using conservative assumptions, that this investment will give you satisfactory returns? If the answer is yes, buy it. Hold it. Ignore what Mr. Market says every day. If the answer is no, don't buy it just because the price keeps going up. Let me tell you about Mr. Market. I created this character to help my students understand something important. Imagine you own a business with a partner. His name is Mr. Market. And every single day he shows up and offers to either buy your share or sell you his. Sometimes he's wildly optimistic, offers you high prices. Sometimes he's depressed, offers you low prices. Here's the key insight. You don't have to trade with him. You can just ignore him when his price makes no sense. Wait for prices that actually reflect the value of the business. But here's what happens in bull markets. Mr. Market shows up day after day, month after month, year after year, with higher and higher prices. After 3 years of this, you start thinking, maybe he knows something I don't. Maybe I'm missing something. Maybe I should pay his price. That's the track. Mr. Market doesn't know anything. He's manic-depressive. His enthusiasm doesn't mean prices are justified. It just means he's enthusiastic today. Your job is to use his mood swings to your advantage, not to be infected by them. Now let me tell you what actually went wrong with me. Because the pattern repeats, and I see people making the same mistakes today. First mistake, I stopped calculating what growth rate was actually priced into the stock. I'd look at a company trading at 30 times earnings and think, but earnings are growing 20% a year. The question I stopped asking was, for how many years must earnings grow at 20% to justify this price? And what are the odds that actually happens? Most people don't ask that question. They just see growth and assume the price makes sense. Second mistake, I started measuring my success against other people instead of my own standards. My neighbor made 50%. My colleague doubled his money. Suddenly, my 15% return felt inadequate. But here's the thing. 15% compounded safely is wealth. 50% that disappears in a crash is disaster. Third mistake. I forgot that investing is about preserving capital first, growing it second. When everyone around you is getting rich, preservation sounds like timidity, sounds boring. It's not. It's wisdom. After the crash, I had to rebuild from almost nothing. And you know what haunts me most? Not the losses themselves, but the opportunity cost. In 1932-1933, wonderful businesses were selling for pennies on the dollar. I saw them. I understood they were bargains. But I didn't have capital to deploy because I'd lost it chasing the final surge of a bull market. If I had simply maintained discipline in 1928, 1929, if I had sat still and looked foolish while others got rich, I would have had money to invest when everything was genuinely cheap. Instead, I was broke. So let me ask you something. Right now, wherever you are in the market cycle, are you making exceptions to your standards? Maybe you bought one stock at a price that made you uncomfortable. Maybe you told yourself it was fine just this once. Maybe you convinced yourself your analysis justified the price when you know deep down it didn't. Stop. I don't mean sell everything tomorrow. I mean stop lying to yourself about what you're doing. If you're truly investing, you can explain exactly why the business is worth substantially more than you're paying, using conservative assumptions, with a margin of safety. If you're speculating, you're buying because you think the price will go up, or because everyone else is, or because you're afraid of missing out. Look, there's nothing morally wrong with speculation, but know which one you're doing. Because when markets turn, and they always turn, speculators get destroyed while investors survive. The market will test your character more than your intelligence. I taught at Columbia for nearly 30 years, and you know what separated the successful students from the others? Not intelligence, not analytical ability. The ability to sit still, to ignore Mr. Market when he was being foolish, to only act when prices made sense. That discipline, that ability to do nothing when there's nothing intelligent to do, that's what separates investors from speculators. So here's what I want you to do. Be honest about what you're doing. Maintain your margin of safety. Think independently. Don't let Mr. Market's mood determine your view of value. Don't measure yourself against your neighbor's returns. Don't forget that preservation comes before growth. And remember, looking foolish temporarily is better than being ruined permanently. The principles don't change. Human psychology doesn't change. Markets will always go through cycles of greed and fear. Your job is to stay disciplined when discipline is most uncomfortable. That's what I learned in 1929, and I'm sharing it with you today, so you don't have to learn it the hard way. Look, we've covered a lot today. Bull markets, Mr. Market, the mistakes I made, probably more of my failures than you wanted to hear about. But here's what I want you to take away from this. When everyone around you is making money and you're sitting still, that's not failing, that's discipline. Next time we talk, I'll show you how to actually calculate what a business is worth, so you'll know when Mr. Market is being reasonable and when he's lost his mind. Until then, look at your own portfolio. Be honest with yourself about what you're doing. See you next week.